Hi students, so this lecture for BBA second sem on corporate accounting first. In the last lecture we saw the net problem on the net assets methods. Okay, so these are the methods of the valuation of the shares. The first one is what's the net assets method, and second one is what's the yield method. Under this yield methods there are two or three main methods are there, which is the valuation based on the rate of returns, and in under that the one valuation based on rate of dividend as well as the valuation based on rate of earning, and the second one is what's the valuation based on price earning ratio and the valuation based on productivity factor, and last main third one is what's the fair valuation methods. Okay, out of these methods the first one is the finished net assets method. Second one is now in this session we are going to start the yield method. Okay, so now see the yield methods. Under these yield methods there are three methods, which is the first one is what's the valuation based on rate of return, and the valuation based on price earning ratio, and the valuation based on productivity factor. Okay, so yield method, so the yield method it's concerned to the going concern concepts. Okay, it's related to the what's the going concern concepts. It means what's the business or company is continuously going on year by year. At that time this yield method is using for the valuation of the shares. Okay, so it will continue its activity for the years to come. Okay, so that's for it's the yield method is using. Okay, so now see first one is that valuation based on rate of return. Okay, valuation based on rate of return. So again in that it's two methods, valuation based on the rate of dividend as well as the valuation based on rate of earning. Okay, so now see the first valuation based on rate of return. So you know that what is my rate of return. So rate of return, it means what's return which shareholders earn on the investment. Okay, so whatever the shareholders are invested money into shares, and on that whatever they are getting, whatever they are earning is nothing but what the rate of return. Okay, and rate of return, this is the methods. The value per equity shares depends on rate of return. Okay, so this is about the valuation based on the rate of return. Okay, so just keep in mind what is my rate of return. Rate of return means what's the shareholders earning the money on invested money into in the shares. Okay, next in that first method is what's the valuation based on rate of dividend as well as the valuation based on rate of earning. So first of all we will see valuation based on rate of dividend. So it means what it is based on rate of dividend, and it is suitable when shareholders holding small block of shares as they are interested in dividend. Okay, so suppose if the shareholders are interested to take the dividend, then he has to block some shares. Okay, it means what he has to purchase some shares, then he will get the dividend. Okay, so now for value of shares, how to calculate in this method, what's the formula? Value of shares is equal to paid up value per shares. Okay, paid up value per shares we have to take here. Okay, so like this, if it is given share 24,000 shares of rupees 10 each. Okay, so this 10 each is nothing but the paid up value per shares. Okay, into expected rate of dividend divided by normal rate of dividend. Okay, so this expected rate of dividend they will not give, but we have to ascertain that. So now how to ascertain that expected rate of dividend? So expected rate of dividend is equal to profit available to equity shareholders into 100 divided by paid up equity share capital. Okay, paid up equity share capital. Okay, so earlier we example saw the 24,000 shares are there into 10, it's a total capital will be the 2,40,000. So this 2,40,000 we have to take as paid up equity share capital. Okay, and paid up value per shares we have to take as a each share price we have to take. Okay, so like this we have to solve the problem with the help of this formula. Okay, so now see the problem. The following are the particulars relating to Basu Company Limited. Okay, so under that A, the paid up share capital of the company consists of 1,000 preference shares, 15% preference shares of rupees 100 each, and rupees 30,000 equity shares of rupees 10 each. Okay, so there are two shares are there, the preference shares as well as what's the equity shares. Okay, the preference shares, 1,000 preference shares are there and each share price is rupees 100, and the 30,000 equity shares are there and each share price is rupees 10. Okay, So next, the average annual profit after provision for income tax amounted to rupees 1,24,000, sorry, 1,25,000, and it is considered necessary to transfer rupees 20,000 to general reserve before declaring any dividend to shareholders. Okay, so this is third one. It means what's the average profit is given. So this how, when it's required, when the for the calculation of the expected rate of dividend. So what's the formula of the expected rate of dividend? Profit available to equity shareholders. We have to calculate what's the profit available to the equity shareholders. Okay, so at that time it's using the B point. Okay, it means what's the profit will be, the total is profit 1,25,000. Out of that profit we have to first of all transfer the general reserve as a 20,000. Okay, as well as the dividend also we have to transfer. And where is this the dividend? Dividend is given to the preference shares, and this 15% is nothing but the dividend. Point number 1a, here it is given the 15% preference shares of rupees 100 each. It means what's 15%, it is the dividend we have to give. Okay, so now see the point number C. Later on we will see that point number A and B how to solve this. Okay, so point number C, the normal return expected by the investors in equity shares from the same type of business carried on by the company is 10%. Okay, so it is the rate of return. Okay, so the calculate the value of equity shares on the basis of dividend yield. Okay, so now just first of all we should know the we have to calculate the expected rate of return. For that purpose we should know the shareholders equity shareholders profit. Okay, shareholders profit we should know. So first of all we will calculate the profit available to the equity shareholders. Now see, average profit is given here 1,25,000. so less transfer to general reserve, we have to transfer the general reserve as rupees 20,000, remaining 1,05,000. Okay, so now this from this now 1,05,000. Okay, so whatever the share capital is there, preference share capital is there, on that 15% dividend we have to minus. Okay, so less preference shares dividend, 1 lakh into 15 divided by 100, it's a 15,000. so now how it's came 1 lakh. Now see the point number 1, the paid up share capital of the company consists of 1,000 shares. These are the 1,000 shares, and each share price is rupees 100. so 1,000 into 100, it will be the 1 lakh. Okay, so this one, on this 1 lakh we have to less the 15% dividend, so you have to calculate the 15% dividend. Okay, so the dividend is 15%, how many rupees? 15,000. Okay, so now you have to minus from this 1,05,000, remaining amount will be the 90,000. so this 90,000, it is the profit available to the equity shareholders. Now put into formula for the calculation of the expected rate of return. So profit available to the equity shareholders divided by paid up capital into 100. Okay, so now see expected rate of dividend, how to calculate the profit available to equity shareholders. It's a 90,000. Paid up equity share capital is a 3 lakh into 100, it's a 30%. so this paid up equity share capital, now see in this problem point number 1, after the preference shares, 30,000 equity shares of rupees 10 each. Okay, how many shares are there? 30,000 shares are there. Okay, and equity share capital will be there 30,000 into 10, it will be the 3 lakh. Okay, so 90,000 divided by 3 lakh into 100, it's a 30%. Okay, so now with the help of this 30%, we have to calculate the value of shares. Okay, calculation of value per equity shares, paid up value per share, paid up value per shares. It is for calculation of equity shares, only the equity shares matter. Okay, so preference shares doesn't matter, but for the calculation of the profit, it is the matter the preference shares. But while calculating the value per shares, at that time only equity shares matter. Okay, we have to consider only equity shares. Okay, so paid up value per equity shares is 10 into expected rate of dividend is a 30, normal rate of dividend is a 10. Okay, so 10 into 30 divided by 10 is equal to rupees, what's rupees 30 only value per equity shares. Okay, so under the rate of dividend method. Okay, so just try to understand, all of you note down the problem on your notebook. Okay, so if you have any query or any difficulty with this, you can please ask. Okay, so thank you.